Can you imagine your oldest and most loyal friend, whom you have trusted for over half a century, suddenly turning away from you? This is exactly what is happening in the global financial markets today. The country that was once considered the largest and most stable buyer of U.S. government debt, treasuries, Japan, has now made a historic decision. Tokyo is no longer quiet, but rather with a clear strategy executing a large-scale exit from U.S. government bonds. Just a few years ago, this was unthinkable. This is not just an economic headline. It is a geo-financial earthquake that is shaking the foundations of the global financial system, and the supremacy of the dollar is facing a serious challenge for the first time. The question is, why is Japan suddenly taking this step? Does Tokyo no longer trust Washington? And what will be the impact of this historic change on you and the world's economy? For detailed analysis of such important and game-changing news, be sure to subscribe to our channel and turn on the bell icon so you don't miss any essential information. To understand this major shift, we must first understand the nature of the financial relationship between Japan and the United States. Historical context. Since World War II, Japan and the U.S. have been bound in a deep strategic and economic alliance. Due to Japan's large export industry, especially automotive and electronics, Tokyo accumulated large amounts of dollars. For decades, Japan invested these dollars in U.S. treasuries. This was a natural process. U.S. treasuries were considered the safest financial asset in the world, guaranteeing capital protection and stability for Japan. But from the 1970s to 2024, Japan was often the largest or second largest foreign creditor of the U.S. Its treasury portfolio regularly exceeded $1 trillion. Japan was a quiet and constant financial partner for Washington, providing stability in financing the national debt. But as experts say, when economics clashes with politics, the rules change. According to the events mentioned in the competitor strict analysis, this change accelerated around 2025. The first shock, tariffs. The administration of President Donald Trump announced a new package of tariffs against Japan's automotive industry, citing unfair trade practices. Insiders familiar with the situation confirmed that the shock in Tokyo was so strong that the financial wing of the government discussed the same day whether it made sense to remain the largest holder of U.S. obligations under conditions where Washington is willing to strike Japan's economy without warning. A former advisor to the Ministry of Finance noted that Trump's tariffs became the moment when Tokyo realized that U.S. bonds were no longer equal to security. The new strategy. Dollar dependence in Japan began to be viewed as a serious threat to national security. Japan's new Prime Minister, Sanae Takai, as mentioned in the original script analysis, took leadership and the policy was formally adopted. Diversification of reserves is a matter of national survival. This exit is no longer just an idea, it has become a reality with precise, documented figures. Massive sales. At the beginning of 2025, data from the Japanese Ministry of Finance showed a clear surge in the sale of foreign bonds for the first time, more than $20 billion in just 1 month. Bloomberg and Reuters confirmed that these sales specifically concerned U.S. treasuries. Analysts at Goldman Sachs called this the first systemic signal that Japan is no longer a passive holder of U.S. debt. Government target. According to the Financial Times, the new administration plans to reduce its treasury portfolio by tens of billions of dollars annually until Japan's share falls below the level that makes it the largest foreign creditor of the U.S. Treasury portfolio reduction. 2024, Japan's portfolio exceeded $1 trillion. Mid-2025, according to the Congressional Research Service, the portfolio has fallen so much that analysts have begun to speak of the risk of losing full holder status, the ability to influence the market. Future impact. If this pace continues for only 1 or 2 more years, Japan will cease to play a key role in the American debt market, which will become the largest geo-financial shift since the early 2000s. Diversification.
PM Takai's government recommended reducing the share of dollar assets, primarily in favor of gold. According to the Bank of Japan, gold reserves have reached a new record, which several influential members call an insurance against American unpredictability. Other currencies, the euro, the pound, and even the Chinese yuan. European bonds. Viewers, did you know that Japan's exit from U.S. debt, which amounts to over $1 trillion, is happening at the time when America's own national debt has exceeded $37 trillion? And this is occurring even as America's oldest allies are turning away from the dollar. The biggest question is, if Japan and China, both Asian giants, stop financing America, who will fill this gigantic financing gap in the U.S. public debt? Why has the risk for the U.S. doubled? We will look at all this in the next segment. Japan's exit is worsening a trend that had already begun. China's effect. Beijing has been reducing its treasury holdings for many years. Now Japan's significant move has doubled this effect. Before, the U.S. could rely on at least one Asian giant, Japan. Now both the largest foreign creditors are simultaneously reducing their dependence on U.S. debt. Pressure on markets. Treasury auctions. Due to declining international demand, yields on U.S. Treasury auctions are rising. This means the U.S. must now offer higher interest rates to compensate and attract fewer buyers. Cost of national debt. The cost of servicing the U.S. national debt is approaching $1 trillion per year. All this is happening precisely when foreign demand is thinning. The wave of de-dollarization. Japan's action is not an isolated incident. According to the IMF's analysis, since the end of 2024, more than 10 major holders of U.S. government bonds, including South Korea, Singapore, Saudi Arabia, and several European central banks, have slowly but noticeably begun to reduce the share of dollar-denominated assets in their reserves. The real reason, Morgan Stanley analysts point out that these countries fear a repeat of scenarios where Washington uses financial instruments as a political weapon. The role of BRICS. The BRICS group is creating its own settlement system and advocating for global trade without the dollar. Although this process is slow, the direction is clear. The world needs U.S. treasuries less as a safe asset. Japan is not doing this out of hostility, but as a new security campaign to save its economy if America ever decides to strike even harder with tariffs. We are entering a new global geoeconomic reality, the era where U.S. treasuries had the unconditional support of its largest allies is fading into the past. For the first time in 40 years, the market is not sure who is ready to catch America if it falls. This is the historic change that Japan has initiated. How our dependence on the dollar will evolve in the future will be determined in the coming months. Be sure to leave a comment on who you think could become the new guardian to finance U.S. debt. Share this important analysis with your friends and family so they too are aware of this major global shift. For more valuable and fact-based content, subscribe to our channel and turn on notifications.